Hey folks, my guest today is Josh Lee. He's the founder of Ardius.com, which helps you automate R&D tax credits for companies that innovate. And he was the first M&A deal that Gusto did, which we'll talk about. Josh, you ready to take us to the top?
Absolutely. Thanks for having me, Nathan.
You bet. All right, tax credits is a really interesting space. Main Street seems to be growing like wildfire. Boost AI in Canada also seems to be taking off. Were you sort of in that same space?
Yeah, I actually started back at Ernst& Young, right? Was my first real job out of college and went right into tax credits and incentives. So yeah, for sure. We started way back in the early 2000 period. And so this is now all coming to light with technology.
So you did not launch in 2018. You launched earlier than that?
I was at Ernst& Young, which actually is where I first started. And so that's where the genesis of learning about tax credits and trying to automate the process started. But Ardius itself started in 2018.
I see. Okay. So you launched it in 2018. How much did you spend getting the MVP live?
Actually, it was funny because right before that, I was actually in the venture capital space. And so we had invested in about 23 plus companies. And so it was actually a function of servicing our own portfolio, right? That we actually came up with this because once people find out you're a CPA, naturally they want free advice. And so we actually took them to my former Big Four and they couldn't service us. We were just too small. Some of our companies were pre-revenue and, the labor intensity and the bill rates were just too high for the startups to actually afford. So that's why we actually came up with Ardius to help serve them.
So you spin that out. Did your firm that you were with take a percent of the business at the spin out, or did you own 100% at the start?
Oh, at the company itself, it was me and another two gentlemen who helped the first MVP. This is summer of 2018, right? And so from there, we serviced our own portfolio of companies, and it wasn't much about the revenue so much. It was about, hey, can this work? And then we did take obviously a percentage of the tax savings, the credits itself. So from a cash flow perspective, it wasn't a burden for the actual startups themselves. So it was a win-win in that regard.
Yeah, no, that makes a lot of sense. Now, did you ever go? I mean, did you go full time on this in 2019 at some point and really say, let's build a real business?
Well, that was the funny part. So right after we finished with this first portfolio, we had a couple of CPA firms approach us, people I had mentored, said, hey, Josh, we heard you're back in the game, right? The CPA game. I was like, no, I'm just doing this as a love project, honestly, right? And then from there, we had a couple other venture funds who we had co-invested with at the time. One in particular was Mucker Capital here in LA. And Eric and Will saw this, right? Who were the managing partners at Mucker. And we're like, hey, Josh, what are you doing exactly? And I was telling them about these credits. I was excited to share with them how much money we'd save for each of our startup companies. And they were looking at me and they were like, Josh, we have, we're working on venture fund number 4. We have 3 venture funds. We'd love to run our portfolio companies through this as well. And we think you should go full time. And it was actually based on their encouragement, right? That we thought about it long and hard about, hey, why don't we just do this full time and start, Ardius as not just a love project anymore, but an actual real startup. So
did Mucker invest?
They did. They wrote me the first check. It was more of them convincing my wife, who at the time was like, "What, you want to, become a founder again? That's absolutely nuts, right?" But they were great. They wrote the first check and have believed in it from day one. So they've been.
What was that check size?
They have an accelerator program, so that check size was roughly about 200,000.
Were you in that same accelerator as Alex at Ordermark, same cohort?
Yeah, Alex Cantor, great, good friend with Mike Jacobs and that whole crew. So they actually were one of our first clients.
Oh, I love
from the beginning. Yeah, it's great. And so having been in restaurant tech ourselves or having some investments in those areas, it was great. Obviously, a big fan of Cantor's Deli as well, and so we helped them with their R&D credits. Not only in improving out some of the scalability, right, of the platform, but also they were a big proponent. They were working with Techstars at the time, got us in front of Techstars. We worked with their portfolio a lot, and so kind of instead of going door to door, started looking at some enterprise value, right, with the accelerator funds, the venture funds around town, and even some other institutions that have, a plethora of startups, right, that could actually use this. And that's the crazy thing, right? Alex had never heard of it. Most of these startup companies have never heard about the R&D credit. So
so your model, what percent did you typically take of the savings?
Right now we're averaging anywhere from 10 to about 30. And I say that with a grain of salt, just because it depends on sometimes the size of the company, the complexities. We're also starting to, discount further in different cycles. So that first cycle is kind of a beast, right? We're trying to automate, create a framework. And then once we get past the first cycle, we can obviously have economies of scale, right, to go forward. So we also will look to do that. We're also looking into maybe tiering it, right, into maybe more of a fixed cost, right, depending on, a variety of different variables, raising a Series A, maybe being pre-funded, pre-revenue, things of that sort. But trying to be flexible. And again, the end goal here is to get more credits into the hands of companies that need it. So. And
do you remember in the first year, I always like to ask first year questions. Do you remember how much, tax savings you got for founders in 2018?
Oh, wow. I know it was a benchmark when we hit our first million, right?
When was that? 2018?
Yeah. Yeah, it was, we started at the end of 2018. So this was in 2019. So we hit that mark, and then from 1 to 10 to, I think we stopped losing track. It was almost like McDonald's, right? How many hamburgers have you served? And so I got to a certain point, we hit certain milestones, we celebrated, and then, from there we just kept going. So
you broke 10 million the same year in 2019 in terms of tax savings? Yeah,
for tax savings. Yeah. I mean, we had companies that came to us that were in the $3-4 million range. So it was, we had a huge client,
like just
one client alone, Nathan. It was crazy. Wow. Yeah, they were in manufacturing, had never thought they would qualify for the life of them, and we were actually able to go back, 4 or 5 years, right? Because it is a refundable credit. So we went back 4 or 5 years, and it culminated to about 3-4 million for federal and state credits. So it was a huge win. Yeah.
And so if you look at between your start date, your first deal, all the way up to today, have you guys passed 500 million in tax savings?
That's a good question. I should go back. I honestly,
come on, Joe. You have to know that number. That's like a magic moment.
Yeah. Actually, if you had grabbed my colleague, Janice, she would actually be able to tell you. She keeps track of all the numbers, but I'm willing to guess. Yeah, we probably would be pretty close, just because we have hit some pretty big hitters, right, in the Fortune 500 space. And so their credits get relatively large.
Yep.
Right. So I do believe we're probably close. I don't know if we've exceeded it, but we probably have come pretty close.
That's pretty cool. Okay, great. Let's a little bit more capital history here. Did you only raise the 200 grand, or did you raise more capital?
We actually raised one other note. We raised one convertible note. This was at the time, and you brought up, Main Street. There was another company that was just starting to raise capital. Right. We were always profitable from day one, so we never really thought about raising beyond Mucker's first, investment. But, we were scaling, and we were looking at, a very, linear growth. Like, hey, if we can build this in, twice the budget in half the time, let's do it. Right. That kind of mentality. So we did go out and raise one other note, relatively small to that end. And it was an opportunity to almost, include and integrate folks who believed in us, from 2018, 2019. So Hustle Fund came in, Operate Studios here in OC, Sterling Road, right? Companies, that backed us, AVG, Alumni Ventures. So they all had portfolio companies. That was the one, characteristic we were looking for, that they could also offer this to their portfolio companies as well.
And what was the total size of that second note?
It was $1 million.
$1 million. Okay, so pretty capital efficient then. 1.2 million raised total.
Yeah, I mean, we have our, like I said, competitors out there raising at $500 million valuations, right, or in the hundreds of millions. And so I thought, relatively for what we were offering, and in terms of the size that we were growing at relative to what they were raising at, it was fair, and also just in light of the acceptance, I guess, in this market. It's pretty hot, but with fintech, I call it tax tech, right? It's kind of brand new, and so people trying to understand what credits are and trying to automate that, it's still relatively new. Mm-hmm. I think in that space. So
yeah. So what before the Gusto acquisition? So right up to that, what was the total team size?
We were at roughly 15 at the time. Yeah, we're currently of the 15, we had half
Okay, so
about
was it a tech heavy product? I mean, really, you're basically reading thousands of pages of tax code and trying to figure out how to automate that for folks, right? Was it heavy tech?
it is, yeah. And so I think tax is one of those areas that we feel are most conducive for software, right? Because the tax code, internal revenue code changes all the time, right? Mm-hmm. And it actually makes a lot of sense to change and program that at the top level and then disseminate that down to our customers or clients, mm-hmm. right? So it doesn't matter Republican, Democrat, who's in office, it's going to change, right? And so now we can kind of make those adjustments up front. And we feel that there's a digital footprint, right? If you look at QuickBooks, right, payroll information like Gusto, right, there's information in there that we can actually flag, right? That's a good indicator, right, of things that could potentially qualify, right, for the credit. Tax returns are the same way, right? They give rise to, hey, I think you might qualify for this. You're in this demographic. You're in this location. You have this job title. All these different things, I think we can connect into, a platform and really be able to at least identify or discover things that we've missed, right?
Mm-hmm. And so looking, back to 2018, if you feel like you're sort of maybe flirting with that 500 million in tax credits sort of awarded today, and your low end is 10%, I mean, could I take 10% times 500 million? It's 50 million bucks in total revenue over 3 years.
Well, there's a timing difference, right, Nathan? So in this case, like we're of the mindset and the model, like we didn't, do the big four model where we charge an upfront retainer and, we charge everything up front. So for us, there is a timing difference. So I want to take, caveat that we basically base our fee on utilization, right? It's a big proponent of us working with startups is, hey, we don't want to be a burden on your cash flow. So as cash flow comes in, right? So thereof, we also, are invoicing or billing, right, for that time. So even though it could be 500 million or something thereof, right, it doesn't all hit at once, right? So
why wouldn't the founders, if you told them at Ardius that a founder could get $1 million, why wouldn't they draw down that million from the government immediately?
Yeah, so some examples could be, the way you utilize credits are in two major pathways. One is if you're utilizing it against your income tax, right? That's an easy one. It's right away. So you're right. So for those, you could be a large company that's profitable. If I save you 100 grand, right, you're going to get a $100,000 credit, then we can invoice right away, right? In instances where, let's say you're a pre-revenue company, right, you have no profitability, right? There's another pathway where the IRS will allow you to offset that against your payroll taxes, right? And so your payroll taxes, right, come every quarter, right? It's being filed. And so you may have a credit of, let's say, $1 million, but your payroll taxes may not hit that $1 million, right, until year number 2, 3, or 4, right? And so that comes in time. And so therefore, if you're only hitting, let's say, 50,000 per quarter, right, you may only use 200,000 in credits for that 1 year. So
I see. Yeah, you're identifying what the total credit base is, and then the founders are saying, okay, we have enough income here where it's worth offsetting with this portion of the tax credits Ardius and Josh have given me, but they're not going to do it all today. They might do some 2022, 2023, et cetera.
Correct, yeah. And so that's where we want to grow with startups as well, right? So the fact that they can take this money back or raise a round or hire more people, right? The more people, the more payroll tax, right? The more payroll tax, the quicker they utilize their tax credits.
Yeah. So what was revenue in 2020 before the sale?
Oh, that's a good question. That's something that we're not at liberty to discuss.
Were you past the $1 million run rate, the magical moment there?
We were close. Yeah.
Okay. Yeah, fair enough. Fair enough. Sure. And then as we wrap up here, why was it the right time to exit?
I think it was the right partner, right? I think with us, Gusto's been ahead of the curve in terms of automating the R&D credit itself, number one, having the vision of integrated and embedded payroll, number two, right? And then us being being able to access that information, being able to identify customers, right, that qualify for the credit, that have not taken their credit, right? So all these different things, having access to that information together made a lot of sense. And we thought we could accelerate, right? Just because our alternative might have been a Series A raise, and to scale, a lot of that would be, for marketing, for getting in front of customers, but they already had all the customers.
Yeah.
Right? It was a big deal for us. So.
What were you, I mean, you come from VC, so you probably know this well. If you were going to do a Series A, how much would you raise and what valuation do you think you could have raised at?
Our target was somewhere close to probably about 10 was what we were thinking about raising, 10 million.
On a right? What? Or something?
Yeah, that was the thing. We were all over the place. We got offers uh, anywhere at a 50 million, 100 million. I mean, even one that was above that as well. So it could have been all over the place. Again, depending on terms, right?
So what do?
So,
You take the term sheet with the highest valuation and say, Gusto, pay this amount and we won't go raise a Series A?
no, I think we were at a different place, right? I mean, again, there was nobody that was literally on our cap table at the time, right? We had a convertible note at best. And so it was easy for us to make a decision quicker and faster. So we didn't really have to worry about valuations, right, at that time. So.
All right, Josh, good stuff. Let's close with the famous five. Number one, favorite book.
Favorite book is by John Maxwell. Right?
Which one?
21 Irrefutable Laws of Leadership. One of my first business books that I still have on my desk or in my bookshelf here in the back. So
number two,
love that book.
Is there a CEO you're following or studying?
Well, he's a good friend of mine. His name is Kevin Chu. Was the CEO of Kabam, right, in the gaming space, and now is doing I don't know how many ventures. Is founded Gen G, which is probably the number one esports team, and now doing a company called Rally in the areas of NFT and blockchain and all that stuff. So I love what he's doing. I always have, and following a lot of his stuff. So
number three, what's your favorite online tool for building the business?
Oh, it's got to be Gusto and Ardius. Come on.
No, it can't be Gusto.
I can't do that. What's that? Number one. So tool. That's a good question. I have my go-to playbook. I mean, we always use like HubSpot, right, for CRM.
What do you use for like data ingestion? Do you use anything like Flatfile?
We've tried a couple other things. I mean, the one tool I love, I'll give them a plug, is Carbon. Carbon, yeah. Carbon HQ. I think they're really conducive for the back and forth chatter between a potential client, customer, and sorting out through lots of information. I think they're great for organizing information, following threads, right? Obviously, Slack is doing that on a more real time and eliminating emails, but I think Carbon is a good solid roadmap and framework for actually organizing data and information.
Very cool. Number four, how many hours of sleep do you get every night?
Oh man, well, that's not fair because I have 4 kids.
Oh my gosh.
So aside from the startup world, being a dad of 4, so I'm probably averaging about 6.
That's not bad for 4
kids. It isn't bad. Yeah. And so, that again it fluctuates from probably 4 to 8, but I'm averaging 6.
So married, 4 kids. And how old are you, Josh?
I'm in my turned 41.
41. That's exciting.
So I'm in my 40s. Yeah. I heard the average age of a startup founder now is 45.
You're
I felt like a dinosaur when I started, but now I'm feeling like,
it's all ahead of you. All right. Last question. What's something you wish you knew when you were 20?
Well, what's something I wished that when I was 20?
Something you wish you knew when you were 20.
Oh, so I wish I had taken more risks, right? I mean, I started with Ernst & Young, was there for 14 years. And by all accounts, I thought I was going to be a historian there or a lifer. And so it got really comfortable really fast, right? Great job, great people, great firm. But fell in love with the startup world in my 30s, right? And I've never looked back. And I wish someone had come to me and said, hey, maybe take a few more chances, right? What's the worst that could happen? You could always go back to your 9 to 5 or a really good paying job. But I mean, there's nothing I would trade like, doing what I do now.
Guys, tax credit company Ardius recently sold to Gusto, got started in 2018 serving as portfolio companies, eventually spun it out with 3 co-founders, took it live in 2018, and in 2019 broke the 10, 20, 30 million, before you know it, 50, 60 million in tax credits identified for these firms, flirting with a $500 million number there now as they've teamed up full-time with Gusto. They were looking at maybe doing a Series A in 2020 and said, instead of raising like a 10 on a 50 or 100, it makes more sense to partner up with Gusto and keep building. We'll see what happens next. Josh, thanks for taking us to the top.
Thanks for having me, Nathan. Appreciate it.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.